Hello and welcome to the look ahead for the week beginning March I do believe it's March the 10th. We're starting to race through the months. Okay, so just before we get started, as always, I'm just going to ask you to take a quick look at the risk warning. I'll put myself on mute whilst you do so. Okay, that's great. So kicking off, let's just begin. I mean, this week has been a pretty key week as far as moves are concerned. We just need to have a look here at what's been going on. This is the US Nasdaq. We've kicked off the week with Trump applying trade tariffs to Mexico, Canada and China, and we finished the week with Trump walking back on some of those, or sort of at least deferring significant amounts of products and services with those trade tariffs on them until later for a month. So I mean, there's been a lot of flip-flopping as far as trade tariffs are concerned. Obviously, the prospect of this trade war is really hitting sentiment, along with the inability to plan. Companies don't know whether they're coming or going, which is hitting sentiment and just raising concerns that these policies by Trump could be sending the US economy towards a recession. Those recession fears, despite data holding up okay this week, obviously, we haven't had the US non-farm payroll report yet. That's due out in about an hour and a half. But, you know, we've had the ISM services PMI, which came in slightly better than expected. We saw that, okay, ADP payrolls were considerably weaker than forecast, but that's most likely. We've also seen that the challenger job cuts were significantly larger than forecast, but again, that's most likely owing to the it is owing to the federal cuts that we've been seeing being applied by Elon Musk. So recession fears are growing in the US, and that's really weighed on stocks, but there is a high level of uncertainty surrounding whether we will see these trade tariffs fully applied or not, or what will actually happen with them. So this is the Nasdaq. I mean, it did find support here quite nicely at that 20,000 level where we thought it would. Has recovered slightly. Doji for the futures, so a little bit of indecision. A lot's going to depend on the non-farm payrolls, but we have fallen below that 200 SMA there at 20,300. We've also got the RSO teetering on the brink of oversold territory, so maybe we are seeing a bottom in there. Buyers are going to need to see a rise above the 20,300, but I think so much of this does actually depend on the data today. Before we look towards next week, the other one that I just wanted to point out for its massive moves this week has been the euro US dollar. There isn't much in the way of euro data next week, so we'll have a look at this now, but this is on the back of that fiscal move in Germany, fiscal U-turn basically, where we've seen likely to be Chancellor Friedrich Merz agreeing with coalition partners, or likely to be coalition partners, that to basically reform the debt brake which they had in Germany, basically enabling them to spend significantly more on defense and infrastructure in a bid to boost growth. And the euro loved it. I mean, the treasury yields sunk. The German Bund sunk, German yields soared, and we've seen the euro has also rallied hard. We've also had the ECB cutting rates by 25 basis points last week. They also hinted a potential pause because of the uncertainty surrounding the possibility of a trade war with the US. We still don't know. That'll come out in April, whether we see those reciprocal tariffs or not. And basically we've seen a surge in the euro on the back of those expectations that maybe the ECB is going to be pausing rate cuts, in addition to that huge spending, which is expected to help lift growth in the euro area, which has been very stagnant. Obviously, that combined with US dollar weakness has sent the euro really quite high. Next level on the upside, 103.30 ahead of 110. It's above the 200 SMA, but we are in overbought territory, so just beware as far as chasing gains higher from here. There could be a period of consolidation. But anyway, let's crack on with what's going on next week. Obviously, any comments from Trump regarding trade could significantly influence the mood. We're actually just going to kick off with what's going on in the US. We've got US inflation data, which is going to be very closely watched. We've got the CPI on Wednesday, PPI on Thursday, and also the Michigan confidence on Friday. That's the forward-looking report. Now, confidence for business and consumers has fallen sharply. So again, we will be watching that very closely. That sort of gives us some clues over what might be happening as far as forward-looking data is concerned. But anyway, as far as US inflation is concerned, it rose to 3% in January. That marked its highest level since 2024, having fallen as low as 2.4% in autumn last year. Now, this rebound in prices was significantly concerning for the Federal Reserve to be able to pause its rate cutting cycle in January. It had cut, let's not forget, 100 basis points worth of cuts in the end of last year, and policymakers have basically halted the cutting cycle, given the uncertainty surrounding Trump's policies, what that might mean for the US economy, inflation, and because we'd seen this US exceptionalism help inflation remain sticky. Now, I think it's worth noting that that optimism that we saw regarding Trump being a pro-business, pro-markets candidate has quickly really been wiped out. You know, the stocks have fallen sharply, yields are lower. Interestingly, yields are lower even though US trade tariffs are expected to make things more expensive, and that's basically because of these concerns over the recession, a recession in the US economy, or at least towards stagflation. So as far as inflation is expected, we're expecting it at 2.9%, so down slightly from 3%, and core inflation is expected to cool to 2.3%. If we get weaker than expected inflation figures, that may raise those recession worries, and in which case we may actually see stocks coming under more pressure if the data is significantly weaker than expected. Now, this is the S&P 500. We can see it's fallen really quite significantly from that all-time high that we saw just the middle of February. So in a space of 2 short weeks, we've seen a very steep drop-off from 61,030 to a low yesterday of 57,010. We're just testing the 200 SMA there, as you can see. I mean, obviously, again, we've got today's data to bear in mind, but, you know, as I said, if those recession fears continue to build, watching out on the downside, that 5,700 as the next level on the downside, that was the November low, and then below there, really, sort of 5,600 would be the next level to watch. As far as gains are concerned, should we get sort of an inline reading maybe that suggests that inflation is just cooling nicely back in line with expectations? Maybe we'll see a rise above the 57.80. That's the first level on the upside that we need to clear before bringing that 58.50 sort of level into play, and the 59.20 on the upside. Just let's also have a look whilst we're on US equities or what's going on in the Dow. Okay, so we've looked at the Nasdaq. This is the Dow. Okay, it hasn't fallen so steeply, although it did, you know, we had those all-time highs at 45,000, and now we're trading at around the 42,300 level. That was the low. It's managed to hold above this support zone that we're watching out for, which is around the 42,300. That's also the 200 SMA in there around the 42,000 level. So if we can stay above that, then buyers are going to be next looking on the upside at 43,300. Then we've also got 43,700, the 50 SMA, which is worth just keeping an eye on. Should data next week raise concerns, or should Trump call out any new policies which would raise concerns of recession, then we could find on the lower side that this is tested. I mean, if we have a look, it's been trading above the 200 SMA since October last year. So if we do get a fall below that, that I think would be quite significant. And we've already had a look at what's going on with the euro US dollar. Let's just have a look at the dollar just to see what's playing there. I mean, again, we can see this really steep fall off. This is again that same sort of date that we've been watching. It's when the trade tariff worries really started to kick in. Beginning of March when they were applied, we've seen a very sharp fall in the US dollar, taking out the 200 SMA. Seems to be just steadying around above this sort of the 103.50 level. That's where it found support yesterday. So, you know, if we continue to get weak data, then watch out for a break below 103.50. Could open the door towards the 102 level. But we do have the RSI in oversold territory. So again, maybe we've just seen enough of a sell-off for the time being. Might see a period of consolidation, at least in the US dollar. Okay, so other things to be watching out for. That's the main focus as far as I'm concerned next week. We do actually have an interest rate decision next week from the Bank of Canada, which is very interesting given the timing of this rate decision. So, I mean, the Bank of Canada will announce their rate decision on March the 12th, and the meeting comes basically after the central bank cut lending rates by 25 basis points in the January meeting, and that took rates to 3%. Now, since then, as far as data is concerned, we've seen CPI rose just modestly to 1.9%. We saw core CPI climb to 2.1%, so that's above target, up from 1.8% previously. Meanwhile, the Canadian economy was showing signs of improving. The IV PMI that we saw released this week rose to a 7-month high in February. Also, employment is showing signs of improving as well. Now, the big question is regarding tariffs. Now, as I said, you know, Trump applied the 25% trade tariffs at the start of the week, but then he's significantly expanding the goods exemption, which raises the question over what the Bank of Canada will do next. Now, when Trump had applied the trade tariffs, expectations of a Bank of Canada rate cut surged to 90%. That was up from 30%. But the latest developments does add an element of uncertainty, because if there are many goods which are exempt, well, you know, it means that actually the trade tariffs won't have that same impact of really likely sending the economy, the Canadian economy, into recession. So, I mean, consensus expectations are for another 25 basis point cut, but I do think the outlook has been muddied slightly given these exemptions for at least for a month anyway. I mean, the uncertainty is definitely there. Now, interestingly, this is the US dollar, Canadian dollar. We hit that high there. We faced rejection at 145.30, 135.50, and we've actually seen the loonie strengthen over the past week or so, which is quite interesting, but that's a result of that US dollar weakness, those concerns of a recession in the US pulling the US dollar sharply lower. Actually, it has overshadowed the weakness that could be potentially coming from trade tariffs applied to the Canadian economy. So that's quite interesting. We just seem to be sitting here. This is a fairly familiar zone that we're sort of hovering around here at the 143 level. This is a level that prevented losses quite on numerous occasions across the end of last year. There was a quick peek down into this lower zone, which opens the door to sort of 142. So, if we get ongoing US dollar weakness, then that's the next level to be watching out for, around the 140-41.80-ish level. And then on the upside, though, if we find that maybe we have a more dovish than expected Bank of Canada and we see a revival in the US dollar, that could bring the 50 SMA into focus at 143.50 and above this level here, which is the 144.70 level. It's a level that seems to be just keeping those gains in the pair capped at the end of last year and the start of this year. So very much depending on the tone of the Bank of Canada and what they actually do. I mean, if they pause rate cuts, then we might find that we see quite a strengthening in the loonie, given that those rate cuts are broadly expected. The next one that we're going to have a look at is the sterling US dollar. Now, as far as the sterling US dollar is concerned, we'll be watching out for UK GDP data tomorrow. Next week. It's released on Friday. As far as the UK economy is concerned, the economy performed better than expected at the end of 2020, and that's basically because we saw some improvements as far as accommodation was concerned, and as far as spending on accommodation and hospitality as well. Although, I mean, if we think about what those PMIs were like at the end of last year, well, they were really quite depressing, and so were retail sales. So I think that growth that we saw in December was a little bit surprising. But also it's worth noting that we saw strong government spending, which is not necessarily sustainable unless there is some strong private sector inputs as well. So I mean, as far as construction was concerned, that was also positive at the end of the year, but given the latest construction PMI data yesterday, that again looks unsustainable because that looked particularly weak. So, there was a little bit of a silver lining in the fact that GDP was better than expected in December. I think broadly speaking, the UK economy is still weak, and that is likely to be shown in the GDP data in January with another contraction expected. So that's what we'll be watching for in GDP data. This is the pound. Obviously, the pound has recovered quite substantially from that 121 low. But again, this is very much a story of a weaker US dollar that we've seen coming into play here. This is the pound is almost trading up towards that 130 level. It's above the 200 SMA. If we see stronger than expected UK GDP data, then I think that 130 level is looking quite attainable. If we see any weakness in that GDP data, then that could just raise concerns over the economic outlook, particularly as we head towards the budget at the end of this month, where Labour could consider cutting taxes in order to balance the books. So, there's quite a lot going on. Bank of England are still expected to cut interest rates a couple of times this year. But we've seen UK inflation is a little bit sticky, still at 3%. It's expected to continue rising to about 3.7% by the third quarter. So all in all, if we do see sort of this stagflation scenario emerging for the UK, which is less than ideal, but as we've got that weaker US dollar, then that is offering some support to the pair. Interestingly, the pound against the euro has slumped 1.7% this week to its lowest level in 5 weeks, which highlights the strength that we're seeing in the euro and the weakness that we're seeing in the pound, although it's stronger than the US dollar. So other things to be watching out for. We'll just have a look. We've also got Japanese GDP data. Okay, so here's Japanese yen, US dollar. Japan's economy is actually expected to have expanded in the fourth quarter at a fairly upbeat pace. GDP is expected to confirm the earlier reading of 2.8% growth on an annualized basis in the 3 months to December 31st. That would be in line with the reading that we saw released in mid-February. And it would also relate to a quarter-on-quarter expansion of 0.7%, which again, it would be unchanged from that earlier reading. Now, private consumption, which accounts for about half of economic output, is expected to show an increase of 0.1% after contracting 0.7% in the previous quarter. Meanwhile, Japanese household spending is expected to have climbed to 3.6%. The data comes basically as the Bank of Japan has lifted interest rates. They're at the highest level in 17 years in January, and growth momentum will be among the key factors which could determine whether the central bank will continue hiking rates this year. The market is growingly or increasingly convinced that the central bank will follow January's 25 basis point hike with a further 25 basis point increase potentially in Q3. Now, if we see strong GDP data, strong house spending data, that could lend some support to the Japanese yen, boosting it further against the US dollar. Obviously, if we see weakness in the US dollar as well following through, particularly if we get weaker inflation data from the US, then we could see a strengthening. We could see this pair deteriorating further. Now, it's interesting because it's trading in this downward channel, which it's been trading in since the start of the year. Interestingly, you know, the yen, when it does get a trend, it tends to run on that trend. So that's what we're seeing at the moment. It's taken out that support there, the 148.65 level, which was the low from December 2024. Next level to be watching on the downside is that 145 round figure. On the upside, if we get a rise above that 148.64, then we'll be looking for 150 on the upside. But as I mentioned, that is going to be dependent on seeing potentially a stronger US dollar, and weak Japanese data could see a recovery in the pair. It would take a move above that sort of 150.60 level, 151, to create a higher high that then exposes the 200 SMA at 152.25. Other thing to talk about is then we also have Chinese inflation data. Now, Chinese inflation data is going to be released over the weekend, so we'll see that we've got CPI as well as PPI figures from China. We're expecting to see CPI slip back into deflationary mode after both on a monthly basis and on a yearly basis. CPI is expected to fall 0.1% month on month in February, and that was after rising 0.7% in January. And on an annual basis, we're expecting a fall of 0.5% after rising 0.5% in January. Producer prices are expected to fall 2.1%, remaining depressed. Deflation in factory prices. Factory prices are firmly under pressure still, which, signals ongoing concerns about China's economic recovery. Now, this is the Australian dollar. Hasn't recovered as well as the other pairs that we've looked at, such as sterling, the yen, or the euro, and that's basically because of these concerns regarding China. And we've also got the RBA, which is considering or starting its rate cuts, given that it was slow to join other major central banks. But yeah, the Aussie remains under pressure. It remains below the 100 SMA. Failed here at this point, 163.50. That was the low that we saw in August 2024. Failed to retake that level, is once again falling under pressure. Down here, next level to watch on the downside is 0.6264, which is the 50 SMA. And then below that, 6,200 would be the next level to watch. If we do get stronger than expected data from China, then we could find that we see a recovery in the Aussie, and that could see the price rise above that one sort of 63.50 level, and then this level here around the 6,400 level. That was the peak that we saw in late February. Now, finally, just a couple of commodities to watch out for. Let's have a look at oil, because oil has had a very challenging week. Couple of points, although it's up today, I mean, it's down sharply on the week. We've seen it fall off, fall to a multi-year low here at 65.22 level. Last seen was back in 2023 and 2023 low. Basically, we've got concerns here because not only do you have OPEC Plus basically looking to increase output, or pressing ahead with their plans to increase output as from next month, but we've also got the idea of these trade tariffs. If they do go ahead full pelt, which it doesn't appear like they are for now, but they may still, that would also hurt demand. We've obviously also got concerns over a recession in the US, which is adding to that weaker demand outlook picture. So between the prospect of increased supply and the weak demand outlook, oil has fallen to multi-month lows. Will we see a recovery? I think that this depends on a lot of things. If we see the data really add to those US recession fears, then oil could fall further. Obviously, any comments from Trump regarding output, regarding trade tariffs, etc., could impact oil prices as well. The RSI is below 50. Potentially we could see more downside, although we've got a fairly long lower wick on this one, suggesting that the selling pressure at those lower levels wasn't as strong. But as far as supports and resistance are concerned, 66.50, 66.30, that's the level on the downside to be watching. And then if we get a break below 65.20 on the downside, would create a lower low. On the upside, we need to rise above 68.50 in order to see some sort of stability in the price forming, and a rise above 70 to create a higher high. Just finally, let's end with gold. Gold is interesting because despite all this uncertainty, despite the weaker dollar, we still have gold not trading at all-time highs. It's fallen away from all-time highs. It's sort of hovering around that sort of 29.25 level, down from that all-time high of 29.56 reached at the end of last month. But I think, you know, the outlook for gold I still think is bullish. I think given the levels of uncertainty, given the weaker dollar, given the prospect of central bank loosening, there is still a likelihood for the US dollar to head, for gold to head towards the 3,000 level. For now, we're seeing a bit of consolidation. You know, I wouldn't be concerned about this unless we saw a fall below the 28.50. That'd be a level to watch on the downside. Obviously, we've got immediate support here at the 28.80 level, but even below, it would take a fall for me below the 27.90 to really form a more neutral pattern as far as the gold chart is concerned. So thank you very much for coming today. I hope you've enjoyed everything we've discussed, and I'll look forward to seeing you next week.